Welcome to Trading Nation. I'm Sara Eisen. President Trump casting some doubts this week over whether U.S.-China trade deal will actually get done. It suggests a trade war may still be a clear and present danger to Wall Street. So says our next guest. Yale professor Stephen Roach joins us on the phone with analysis, former chairman of Morgan Stanley Asia. Welcome, Professor Roach. Nice to talk to you.
Good to talk to you, Sarah.
So you've always been alarmed at the rhetoric here. I think the markets breathed a bit of a sigh of relief earlier this week when the Treasury Secretary said the trade war is on hold. But you say there's still some big risks.
Well, you know, the Treasury Secretary says one thing one day, and the President says one thing the next day, and it's sort of back and forth in terms of giving a clear and direct message as to what to make of this. But the bottom line is China has been one of President Trump's core economic issues, and I'd be surprised if he just capitulates on this. So I think we have to look at the risk of some type of trade tensions very seriously.
How do you expect it to play out?
I think there will be some tariffs. I think there will be further push in the intellectual property rights area as per U.S. Trade Rep Lighthizer March 22nd report. I think the standard view in Washington right now is to take China as a very serious threat to America's most competitive industries for the future, and there's bipartisan support in favor of that. And I think the case that was raised against the telecom company ZTE is just an indication of how serious the concerns are. I think a lot of these concerns are overblown, but I think there's a limit as to how far the president's going to backpedal.
Is it ultimately a good thing if we do start to see some of the tariffs that President Trump has threatened and more protections on intellectual property for American companies that want to do business there?
No, tariffs are a bad thing. Trade wars are not easy to win, as the president seemed to suggest, and there are clear alternatives to unleashing tariffs, and a lot of the arguments that have been made on this sort of technology transfer area, I think, are spurious, exaggerated, and not substantiated by fact.
Would you go so far as to say that the market, the stock market, is facing a major risk here, and you would tell people to stay away because it's just such a big problem and you don't see it going away?
Look, we had a valuation spike early this year. The market moved up parabolically in 2017. We've come off a little bit in the last 4 months, but the price-earnings ratio that I look at, the cyclically adjusted price-earnings ratio, is still overextended by any standard of the imagination. So, you know, to the extent that trade frictions represent still a risk, there's got to be some risk still embedded in the market, despite the consolidation of recent months.
So do you think the right strategy would be to tell people to stay away from multinational companies that may get caught in the crosshairs, not to mention the strengthening dollar, which is something we're also seeing?
I certainly think companies that have broad-based global exposure, supply chain exposure, are vulnerable, and certainly multinationals who have benefited from earnings tailwinds from a weaker dollar are now going to be impacted the other way. There aren't too many companies that would escape a net like that, I'm afraid.
Always good to get your take on all of this. Longtime China expert and watcher Stephen Roach, professor at Yale University. And thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.